When you look at your floating storage data, the inventories offshore, is there any reason to believe that OPEC is going to change their plans anytime soon?
You know, there's reason for them to consider it if you think of floating storage inventories and data as kind of a leading indicator, because we see a couple of areas of concern for those guys. I mean, in this middle of the barrel category that we call distillates, you've got diesel and you've got jet, and they're both accumulating in floating storage. We've got like 30 million barrels of diesel floating on tankers around the world right now, going nowhere fast. And diesel is a pretty important indicator of economic activity, not only because it's the transportation fuel of passenger cars in Europe, but it's the fuel of the 18-wheeler truck that takes stuff from factory to market. And then on the jet side as well, we're seeing like 13 million barrels of jet in storage on the seas, and it's really kind of an unusual pattern. So OPEC should keep that in mind as they consider the market right now.
Well, I'm sure they are. And the data, we know that when oil prices collapsed, I mean, not that weird negative trade, but when they were really low for a couple of weeks, everybody we talked to said that China was just buying it up. Why not? You're going to need the oil. It doesn't really go anywhere. If you can store it for cheap, you just stock up while the getting's good. Your data on China is dramatic. I mean, the amount of oil just apparently sitting off the coast of China, I mean, that implies to me that there could be a lot of inventory for a long time.
Yeah, I think that you're reading it right, Brian. Think about how this happened in China and just what it represents. So right now, China is the #1 export destination for US barrels. And from the Chinese side, looking at everything that they get, the United States now accounts for 7, maybe 8% of their total imports. I know 7% doesn't sound like a lot, but if you keep in mind that this has come from zero, I mean, this trade really didn't exist as recently as early this year. So what was going on, if you rewind the clock to springtime, the world was awash in oil. We had plenty of excess inventories. And you're right, the Chinese companies kind of went on a buying spree and picked up a lot of oil from different suppliers at discounted prices. Then a few months later, you had these OPEC plus supply cuts kind of take effect. And so there were fewer barrels from the traditional suppliers, Saudi, other Middle East, Russia, going into all consuming markets, including China. So the United States has been able to maintain this interesting little foothold in this market. So there's a ray of hope for a U.S. oil patch that's had some headaches of late.
Yeah, is there any reason to believe, when I look at all the data, I don't want to opine on oil prices, Clay, but if somebody said, hey, Sully, you got to make a bet, I would say that, for the next couple of months, the path of least resistance for oil prices is likely down, not up. What would you say?
Yeah, I think that that's pretty well substantiated because I'm looking at these floating storage inventories as kind of a leading indicator, like I said. So these middle distillates are building up, and it's going to start to squeeze refineries, right? And so the refineries are in a bit of a dilemma because even though gasoline is a little bit better, for these big refineries, basically the floor of yield that you're going to produce is about 50%, more or less, distillate. And so if that big chunk of your production, Brian, is marginally profitable or potentially even upside down, you're going to be under pressure to just reduce throughput altogether, and by extension, crude oil purchases. And so it's this is kind of the distillate's dilemma for these refineries, that they'd rather produce a little bit more gasoline, but that comes at the cost of producing too much distillate.